Welcome, members. We have 5 minutes to welcome members. 1 minute gone. Hilary, you okay? Welcome, everyone. Members are streaming in pole pole. Okay, thank you. It's 5 minutes past 7. Honorable members, KMA Sako, welcome to our webinar this Wednesday, 19th of March. Our topic is on credit and financial management, how to survive a recession. Our speaker is Mr. Patrick Wameo. I will introduce him in the next few minutes. So this is how we are going to have the program. After, of course, you have joined. We will have a curtain raise as usual from our Medi-Finance, TIBA, on motor claim processing by Zebi Onam. I will then introduce our speaker formally, who will give the talk on credit and financial management. There will follow a Q&A session. But of course, you're allowed to put your questions as we go along there. There's a chat for that. And then we'll give our chairman, Dr. Vitalis Ogola, if he's in the audience, will give a closing remarks. Sorry. Give closing remarks, and finally we will request you to fill survey monkey at the tail end to just rate the program and to make any other comments that you may have. So straight away, I will ask Mr. Zebi Onam, who is our principal TIBA, one of our principals in TIBA, to give a talk on motor claim processing. Zebi Onam, are you around?
Yes, Amaran, good afternoon, everyone. Sorry, good evening. My name is Zebionam. I head General Business, Tiba Insurance Agencies. I'm going to take you through the motor insurance claim. Now, this is Tiba Insurance Agencies. It's always a division of KMSACO. So first and foremost, we're going to start with the definition of motor insurance. You need to understand what motor insurance is before we go to how to handle when you have a foreseen and for unfortunate event in the near future. So motor insurance is just a contract between you and the insurance company that protects you against a financial loss in the near future. A financial loss can be caused by a damage through an accidental means, theft, fire, malicious damage to a vehicle that has been insured. So a policyholder pays a premium, then the insurance provides the coverage. So what is the importance of having the comprehensive cover? It's crucial because it provides financial security and peace of mind when it comes to any unforeseen incident. So what is not covered actually is always the wear and tear, unlicensed drivers, driving under influence, and the mechanical failures, among others. So we are going to understand the motor claims process. So what is a motor claim? It's just a formal request made by a policyholder to their insurance company for compensation following a covered incident involving the insured. So a claim ensures that the policyholder receives financial relief. Financial relief, that means you don't go back to your pocket after paying the insurance. So you let the insurance handle everything for you. So the insurance assesses the claim based on the policy terms, required documentation, and circumstances of the incident that determines whether to validate or reject it. So the types of motor insurance claims, we have four. First is the own damage, and this is the most popular one. So when the insured vehicle is damaged due to an incident, fire, or a natural calamities. Another one is the third-party claims. This occurs when the policyholder is responsible for damages to another person's vehicle, property, or bodily injury to a third party. A third party is someone who is not the policyholder. The third one is the total loss claim, or rather we call it a write-offs. Now, when the cost of repairing the vehicle exceeds its insured value, leading to a total loss. What I mean is when you have an accident and the repair cost exceed 50 plus 1% of the car value, that means that car should be written off. And so the insurance pays the sum insured as per the valuation report. The last one is the theft claims. When the insured vehicle is stolen and cannot be recovered. Now, the role of the customer in a motor claim. We are going to start at the scene of the accident. Immediately, you have that claim. What you should do, you ensure safety, you call for emergency services. Emergency services will be maybe our line, which is always 24/7 working, our mobile phone lines. Then you take clear photo and gather details. That means time, location, the parties involved. The police will be there so that you'll get the police abstract. You notify TIBA Insurance Agency. Reporting a claim should be within 24 to 48 hours. Provide all necessary documentations. If I mention a little, it's the police abstract, the claim form, which we share, your ID, the logbook, and the driving license, and so on. Now, following up is stay updated on the process via TIBA Insurance Agency. Now, TIBA Insurance Agency will take you through the claim from the beginning to the end. You also need to cooperate with assessors, garages, and the agency. Claim settlement timeline. Intimation is the beginning at the scene or when you had the accident within 24 hours of the incident. That means you need to have 24 hours to report a claim. Survey is within 48 to 72 hours. Survey means your vehicle has been hit, it has been taken to the garage, assessor has to assess it, the garage does the quotation. Now, all this process before the insurance approves the repairs, it should take a maximum of 3 days. Now, repairs and settlement takes between 7 to 15 days, but some might take up to a month, depending on the nature of the claim, the spare parts that are not, maybe some needs to be imported and all that. Now, what are the common reasons for claim rejection? Because at some point, the insurance might reject your claim. So the major two reasons is always non-disclosure of facts or misrepresentation. This means when maybe a policyholder does not state the facts on the claim form, or rather states what is not true. The second one is if the repair cost is below excess. Below excess means your motor vehicle policy has the excess protector. Now, any damage that is below excess is always not payable by the insurance. How do you assess that the damage is below excess? If the damage is below 2.5% of the vehicle value of the repair cost. But the minimum, it is capped up to a minimum of 20,000. So any repair cost that is below 20,000 is always not taken by the insurance. So the insured goes back to their pockets. Now, understanding motor claims process. Now, we have the valuation report and the process and role. This is very important. Now, why do we do valuation? Definition first is assess vehicle condition, market value, done by a licensed surveyor. I believe we do send you our members to a Regent, AA, and all that. Now, when is it required? It is required yearly. Initially, it was done after maybe 2 years or 3, but nowadays it's required yearly. The third one, role of the valuation report. Number one is to determine the fair value of the vehicle. So that in case of a write-off, we pay you the fair value of the vehicle. Number two, it ensures transparent claim settlement so that we don't have a back and forth on how much to pay you or how much not to pay you. Because there is a way the insurance calculates the loss or rather depreciation value of the car. But if you don't do valuation, you find yourself going on a loss. The third one is prevent under or over insurance. If you don't do valuation, your car might be overinsured. You find yourself paying higher premiums or underinsured, so that in case of a claim, you'll be paid lesser amount of money instead of the correct amount of money ought to have been paid. Now, the claim settlement methods, we have two. The first is the most common one, the direct payment. Now, the insurer settles claims by repairing the vehicle at the approved garages. Now, when you have an accident, I normally advise our clients that we have an approved garage. We share with you, you make a choice, or we make a choice on your behalf. Because we've dealt with these garages, we know the ones that does best, and we always have the best at hand for you. Now, the process, vehicle is taken to an insurance approved garage. Assessor inspects the vehicle and verifies repair cost. That takes a day. Insurer approves the report, 3 days, as I had mentioned earlier. Repairs are completed and a different assessor will inspect the vehicle. Reinspection is very important because we have to know if the vehicle was repaired according to the assessor's report, the first assessor's report. Then a release letter is issued and the vehicle is returned to the owner. Point to note, the insurer ensures the vehicle is restored to its pre-accident condition. Our next method is cash in lieu. Cash in lieu, the insurer offers a cash payment for repairs or the vehicle's pre-accident market value instead of repairing it. What you mean here is an insured or other policyholder will opt not to go through the insurance garages. So he will tell us that I have my own garage. Can my garage repair the car? Yes, it is possible. Now, what is the process of doing this? The insured select a garage of your own. Now, outside the insurance panel, assessor inspect the vehicle, finalize the repair quotation. The insurer approves the report and pays 75% of the approved amount upfront. The 75% is paid to the policyholder to pay the garage. Now, after repairs, the assessor a different assessor reinspect the vehicle to see if the vehicle has been repaired as per the assessor's report. Now, there are 2 points here. If the repair matches the report, the 20% balance will be paid to the policyholder to pay the garage. Now, if not, that means, for instance, a spare part was costing 80, but a garage goes ahead and replaces with a 50,000 one. Now the payment is adjusted based on the work done. So you find you will be paid less of the amount approved earlier. Write-offs, the insurer pays the sum insured as per the valuation report. That's why I insisted valuation report is very key. Point to note, yearly valuation report is required. Now, frequent asked questions on motor claims. Number 1, how long does it take to settle a claim? Typically 7 to 15 days, but in some cases, it might go up to 30 days, depending on the nature of the car. Number 2, can I choose my own repair workshop? I've just explained. Yes, it's possible. Only if your garage will work with the assessor's report. Number 3, is insured entitled to assessor's report? Yes, he or she is entitled to assessor's report because a policyholder needs to know what is being replaced, which parts are being replaced in his car. He cannot just take the car to the garage and be told that your car is ready to be picked. Now, the last question is there a deductible or excess in a motor claim? Yes, a mandatory excess applies based on policy terms. Check your policy documents. These are our phone numbers. You can reach us out. The first 2 are mobile phones. They are always 24/7. The last one is a landline. That is our group email. You can reach us. Thank you very much. Any question can be posted Q&A. We will be able to respond to them. Thank you.
Thank you so much, Debianam, for that curtain raiser. Members, again, to remind you, we are in our webinar on credit management and financial management, credit and financial management, rather, how to survive a recession. And we are basically here to equip you with the strategies and tools for managing credit and also to be able to reduce default. So that is our main aim of doing this webinar, so that we can lower our default, which as you know, in 2023 really cost us big. And as you're going to see from our reports, the default has gone down slightly. Now, I'll dive straight to introduce our speaker, who is Mr. Patrick Wameo. Mr. Patrick Wameo is a renowned financial literacy educator, a business advisory consultant, and a specialist entrepreneurship incubation. He holds an MBA, Finance and Strategy, a BSc in Horticulture. He's a member of the Associate of the Chartered Institute of Bankers, and also a Certified Credit Risk Assessor, Moody's. He's the one going to talk to us on this very important topic. So, Mr. Patrick Wameo, I think I've done justice to your introduction. I hope you can say more on what you have attained. Now, members, just to put you into perspective, the reason why we call this is because of the challenges we've had since 2020, during COVID. You know what COVID did to us. A lot of us lost jobs, hospitals closed, clinics went slow. So that is the time when we started having problems on default. We had previously been able to maintain our NPL at less than 5%, but this has been deteriorating with time. Then come 2022, we had elections. There was change of government. You know what happened. Levies came up, housing levy, shift to SHA. Our payslips were raided, payments went down. Of course, some of us also run hospitals. NHIF has not been paying, so there's 28 billion lying out there for doctors. Dr. Brian Bishenga is always talking about it, and I hope you're all aware about that. Then come 2024, we've had elections in US. USAID is down. A lot of our members were there. Most of them have also lost jobs. Just on the same vein, interns, there's a threat to lower their salary to 70,000. You know what that means? Those are our members who rely on so much to join the circle and grow the circle as most of us transition to retirement. And then there has been a problem of contractual employment. Our doctors are getting jobs on contract. So, of course, credit management becomes a problem. Just as a sneak preview into what Mr. Patrick Wameo is going to dwell on. Patrick Wameo, please go ahead, sir.
I hope you can hear me clearly.
Yes.
For purposes of the the bandwidth, I will remove the video, but at least you can get to confirm that I am not a hoax. The same face you have on the advertorial is what you see. Now, credit is my bread and butter. That's what it's my profession. Just as you do medicine, I do the medicine for money. Personal finance is a very small part of the bigger element of finance that I do. Specifically, I'm a certified lender. We are only two in this country. One has retired from working. I am partially retired, but I'm still useful. I guess what I was asked to speak about is for both the SACCO and the member, because there are a number of issues that need to be attended to. So I want to start my discussion from, let's call it basics, so that we don't lose anyone. Typically, when you speak credit and personal finance, the common factor or denominator is money. There's money involved. But then now the reason for the money is what now brings in either business finance or personal finance. But at the center of the two, there is the money element. And I think that is what we need to be addressing today. So the objective of this session was set out, it was to, one, to equip the members with practical tools and techniques for managing credit. So I'll be very focused on how do we deal with credit. I want to handle the nitty-gritties. There is nothing basic. Everything basic is important, with the aim of reducing defaults and maintaining financial stability during economic downtimes. Before I go very far, the issue here is managing credit with the aim of reducing defaults. And I'll speak to you. I've done credit in this industry for 30 years. 16 of those years, I was heading lending in 3 banks. I was in lending in Standard Chartered. I was in lending in CBA. I was in lending in housing finance, and I capped my lending in Barclays. The small business where people running clinics would fall into have very peculiar patterns that predispose them to suffering drop in both cash flow and drop in profitability when the economic situation changes to the type described as a recession. So I'll be discussing that in entirety. Unfortunately, the kind of topic we are discussing today, if we were to do PowerPoint, there would be 50 slides and we would lose the value of the discussion. So I will look at that quite a bit step by step. And I would urge you to be with me, take your notes, because I might not be able to put them all in writing. May the person recording the program, may you also do the transcription so that those who are listening can also read from the screen. The other one is to equip members with the necessary tools to navigate financial challenges during recessions, benefiting both the individual and the SACCO. A very small extension from the previous objective. So let's go back to the previous one. Tools and techniques for managing credit. Let's look at the basics first. For any lender, and KMA as a SACCO is a lender, whether you are a commercial bank, whether you are a microcredit, whether you are a SACCO offering a microcredit program, or a SACCO offering a SACCO product, lending process require an assessment, which is one of the key principles of good lending. So I'll take us through that, and I want you to pay attention to what happens, why the assessment, And then what happens when things go wrong? Because the assessment measures your ability today. Things changing like the Trump effect. Allow me to just use the Trump effect, cover all the USAID things. First, for some people, it has taken away income entirely. I've just met a few clinicians today who, until recently, had jobs. They don't have jobs today. So you assess them, and they had the capacity to pay the loan. The loan was largely dependent on the availability of their salary. They may have other income, but the loan was assessed based on their salary. Now that the salary has come to zero, what happens to the loan repayment? I think that is the question that is being asked. And typically in credit, the ideal scenario is to take the full picture of the incomes of the person at the point they come to borrow. Even if you are not going to use the other income, you should have it as part of your lending process. Because then you understand that, oh, this guy, the income from a salary is so much. He may be having monies from locum that you haven't had in any record. He may be having 2 jobs you don't have in any record. He may be running a small clinic you don't have in any record. So from the lending framework, the policy process of the SACCO as expressed in the loan process should seek to collect information when the person is still applying on the full picture of his income, so that by the time things go wrong, it becomes easier to know what else did this person have, and how do we now work with this person on this substantially reduced income to be able to have some loan repayment running, however low it is. And on the part of the borrower, it is also incumbent on you to be able to start asking, how do I continue to meet my obligation, however low it is? And I'll be looking at what are the circumstances that the SACCO may admit that I'm calling low, so that the loan remains green in terms of compliance, as opposed to appearing non-compliant. So it becomes quite difficult when you did not know the picture of my income upfront when I was making an application, to know the picture of my income when I am now in distress, whatever cause of the distress. A lot of people are not very honest when they get into distress, and at the same time they expect to be helped. And I think that is not always a good situation. So there may be need for us. I've not looked at your lending forms, the loan application process end to end. But the more information you collect on the client prior to them receiving a loan, the better when things go wrong, because now you have a foundation from which to start the discussions. And as I said, from the borrower's point of view, it is incumbent on you to go to the SACCO to report loss of income, requesting for a change of term to reflect the new situation, however low it is. You may have been paying 40,000 bob per month, but you are only able to pay 4,000 bob per month today, given the new scenarios. You've lost your job, for example, and the monies that you are making from other sources might only allow 4,000. That 4,000 may be considered for a significant period as the new repayment while you recover. And if that starts at the right time, not starting when things have gone wrong, it is quite in order. If you come to the SACCO with a 4,000 repayment when you're already past 91 days in arrears, the SACCO is now dealing with SASRA putting pressure on you getting the loan fully paid off. The SACCO is now thinking about selling any securities if they are yours, as opposed to looking for other options because you delay. So there is the role being played by BOA. There's the role that the lending, the process of collecting information before we lend to you that plays there. And that needs to be understood by both of us, that a lending relationship brings two parties together. It is mutual. There's no bias. You cannot throw it on the circle, the management process, and you cannot be lazy about it, because when you are lazy about it, the management will be pushed by the authorities that look after the management to push you into pressure, and you will get down further. So it doesn't quite help that perhaps the equipment which you used to secure this loan is the equipment. You also need to make money, and the SACCO is now considering selling it. I don't think that would be a solution in any way. So what would be the right way to do things is we make sure that we have our side of information on you, and you play your responsible role of coming to present your situation as it is and as early as possible, so that then we have a common position. So allow me, with that introduction, to start skinning the topic alive piece by piece. The first thing I put on my slides is, what do I want to discuss? I want to look at the personal financial and credit needs with a view to finding how does the personal and business financial needs and credit meet. So that meeting point needs to come out clearly. Now, clarify the role of the SACCO, and while I'm clarifying the role of the SACCO, I shall have clarified the role of the borrower. So what how do you get to a place we call things have gone wrong? What do we call that situation? What will lead us to believe we're in a state where we are helpless? And what are the options or remedies for getting out of it? And I'll be using a reference to the global lending standards, of which I am very comfortable with. And I'll try to speak a common speak. I'll avoid any language that might require definition, just in case the law tells me. Please feel free to remind me that is not easy for us. Just drop a note somewhere. Sometimes those things happen. Number one, the first principle in terms of principles of personal finance that relate and could lead to things going wrong is just how you manage your money. So in the principles of personal finance, they are what we call the pillars of money. Earning. Anybody whose earnings are from a single source, regardless of the size, has a higher chance of getting out of position than somebody who has multiple sources. That is not always the case in the medical space, because you have the benefits, like you can be an employee in one firm and doing locum in other locations. So locum is itself usually a source of income for certain professionals, not all of you, of course, but for some of you, you do make quite a bit of tidy sums from locums. But then those locums is still you working. So if the recession has the volume of work needed, the locums will also go off or will become fewer. And when that is the scenario, your salary or salary income goes down, and also go down, because the locums are based on your physical availability, meaning your skills, intellect, and hours. The ideal in the personal finance management space is to have an income source that depends on you and another income source that does not depend on you. And I've said is the ideal. It is not what most people do. So the moment you do not have a source of income that doesn't depend on you, you are at a higher risk of getting exposed when things change. Small they are. Since Monday until this evening, the only job I've done is speak to people who have been affected by USA decisions from South Africa through Kenya and a Kenyan NGO. So it is not just happening in Nairobi, it's happening everywhere. There are people who were not even in the medical space directly, but they were in a CBO that was implementing, and that CBO no longer has anything to do. They are jobless, and they were members of a circle. And KMA and Kimisitu have both been mentioned in the meetings where I was. So I expect that kind of issue to affect more than one circle, first of all. So let's go back to expand income sources. Going forward, that would be ideal. As a practitioner in the space of medicine, your incomes can change quite a bit with the demand for medical services. And that, like just the sheer thing, has affected the services, which is a government policy. Before even we were discussing Trump and US aid issue, already who are having medical issues suffering from lack of debts being paid. And that has been a big burden on people who are expecting their incomes to have been paid, and they would use the money to pay off their debt obligations. So already that is one of those things you might not be able to influence. Is one of those things that are outside your control as well. So I think this one we look at forward-looking. Going forward, members need to consider very seriously alternative sources of income that depend less on you. And that requires investment of any income made, including loans. Usually, we would repeat to as many as possible, save regularly. But again, that regularly does not mean that the size is very large. It's about regularity. So that is important. Just keep it in the space there. The space of investing wisely, which leads to bad debt. If the lack of investment, wise investment advice. A clinic can buy equipment that was intended to help it earn more revenue, and the equipment does not deliver, either because of the value proposition of the clinic or for any other reason, including investments in assets that are not purely legal. There could be you bought some land in the wrong place, no growth in value, or you bought land, you didn't follow the processes, you end up with a piece of paper as opposed to land itself. So you basically lost the entire investment. There are many reasons that could go wrong. So that word, invest wisely, when that wisdom element of investment misses, then the likelihood of the financial impact being negative usually is also very high. Then borrow wisely and borrow for good causes. Now, good causes is not a pedestrian word. It's about borrow for viable projects. Viable could be economic, viable could be technical, and viable could be financial. An economic viability can be proven when you are buying technology, some equipment. You guys in medicine use very complicated equipment. I see the kind of equipment you use, for example, in the scan space, very complex. And when you are buying it, perhaps you are the only person in that area, and you are looking at all these clinics around this place will supply me with them, the users. Then in a short while, somebody else has bought another one. So you are now sharing the clinics in a very small space. So what was viable can be rendered unviable by activity of the competitor. I remember at one time when my firstborn fell from stairs and cracked his head and was very small. There was only one lab at that time that I could go to. I can't send me that lab. I don't know the name, is somewhere in Westlands. At that point, if you have that kind of lab, it looks like you are the center of money. But what happens when they become three in a very short time? that benefit which you had when the analysis was being done, the economic viability, the financial viability was there, and even technical viability was there. But the financial or economic viability can change very fast. Technical can change when technology changes also very fast, rendering your equipment less useful in a very short time. So a newer technology is now preferred. And so the people who are investing in the newer technology would then be the ones receiving more of the business and not you. And you invested with a very good intention. And it was doing well initially. Then suddenly you are left with an equipment and a not very responsive market. So borrowing wisely is not a very easy situation to say at the beginning it was unwise or wise. It can change if someone did not ask good questions at the point when you are borrowing. We may buy some equipment that you could have been advised not to buy another one of a newer technology, perhaps more expensive, but which should have taken you longer to be corrupted in the market. So usually what happens when these principles of personal finance were not followed would be some consequences that have to do with either loss of market, absolute loss of income, of market, just a reduction in the volumes, loss in margins. You are now not able to charge premium prices. Some of those services you charge are very expensive. You notice a scan, very simple one, can cost someone 30K, 40K. Not many people are able to spend that amount of money. So as much as they require the service, they want to be able to spend, especially when they're spending from cash. So those premium prices can plummet very easily to 25, 20 when you're competing. Margins go, volumes go, things begin to go in the direction that is not working very well. So when you're borrowing for business type equipment, especially medical equipment that are very specialized, it helps when the viability, that borrow wisely and borrow for good causes element, is put to scrutiny to help you to avoid a possible blackout that may happen when power is still in place. So there could be possibilities around these principles that did not work. Later, when you are actually doing things, when at assessment things looked quite fair, the period 3 to 5 years did not look like there would be a lot of changes, but then things can change very fast. I have seen even very big equipment being duplicated by some people very fast, and that changes your fortune very fast. So that could happen. So apart from economic downturn, just sheer competition in the market can change your fortunes quite a bit. So when it comes to key principles of lending, this is now on the side of both the bank and on the side of the borrower. I mean, on the side of the SACCO, you are supposed to know your customer. And that know your customer is a bit of detail. Allow me to just use the word strengths, limitations, and weaknesses. And here we are referring to financial strengths, financial limitations, and weaknesses. If you don't take a good account of your client, you might be lending with the dark corners. And you only know that you lend to dark corners when the situations change rapidly, that the income can shift in direction and quantum. Direction meaning going down, and quantum, the sheer volume, can shift very fast. And those will always necessarily lead to loss of ability to repay the loan. So like I said at the beginning, the SACCO lending process need to be readjusted regularly to require that we have a very good picture of the income from any client. Even the incomes which we will not use, we call them secondary and tertiary. We ought to know the quantums that exist. And you, the borrower, when you are asked for that income, give the SACCO a better picture of your position that they may have the comfort to lend to you, because they are seeing if one failed, there's a possibility that a small portion of what you have somewhere else could be used to remedy your situation in the interim situation, while both parties are working at what would help both of us be on the right side of history. That requires paying attention to details. Lending is a business of details. And I do know, and I'll be very frank with you, I have designed a lot of lending frameworks in this country. SACCOs do not like illuminating some of these corners. There are things that the minimum lending framework would call for. But that brotherhoodness sometimes becomes too much of a nice thing that we ignore the need to look at the details a bit more. And it is beneficial to both the SACCO as it is to the borrower. And the only time you know that was beneficial is when things are no longer working. So what I would urge you first as a SACCO is to also review, could there be the information that we are not looking at when we are lending to you? Could it help us when we are now renegotiating the change of terms? Because it becomes very difficult for you as a borrower to go back to the SACCO to ask for a change of terms. You are not giving a good picture of your income. The SACCO management's responsibility is to avoid any loss to members' money. And if what you are presenting is proposing loss of other people's money, they will be shy to help you. So it helps if you give us a better picture of your incomes at the time when you are borrowing, letting us know even the things which the monies which we will not use today that you may have, that gives somebody that comfort to want to listen to, okay, this source of income is gone. This one is small, but is available. So how do we work within the current situations to remedy this loan to remain compliant with the what you call the portfolio at risk measurements? Because SASRA require KMA to report every 15 days after end of month on the portfolio at risk. So the CEO is under pressure when he is reporting to SASRA that the portfolio at risk has increased, because he knows what to expect out of it. So he's a human being. Even him or she will not be very willing to listen to you when the corners are dark. But you see, it's quite different. If I had a good picture of your incomes, I can tell where they were, I can tell what has changed. I reassess you based on the present situation and the possibility of how long it will take before things normalize. It becomes a bit of comfort for the lender and the borrower at that point to consider change of terms. But if one side of the house is in darkness, change of terms becomes quite a big issue. So that is the one we call in colloquial, kuku ameenda kutafuta yule mnyama ambaye ukula kuku. So is it the kuku that is wrong, or is it the mnyama that's in the wrong place? Both of them will have some blame. The cuckoo should have been at home. They would have not met the fox. If the fox came home, the cuckoo could not escape. Somehow, both tend to have some role to play there. Of course, when the loan is no longer performing, usually the risk of the loan goes high as the non-performance factors increase, and that puts your loan to be at perhaps even a different interest rate. Typically, we charge each product or each line of loan a different interest rate because of the risk factors. So when the risk factors change, those rates go higher. And when they go higher, the repayment generally tend to increase. When the repayment increases and your income is declining, those things are moving in opposite directions. So we can see what that means. On the SACCO side, they are required to collect hard and to collect fast. On your side as a borrower, if you do not respond by proposing what you're going to be able to do to remedy the situation, even if it's a much, much lower repayment, you are putting yourself at risk. I remember the lending manager and the boss, the CEO, and the board committee in charge of credit are responsible to SASRA to report why things are out of order. So you as a borrower also ought to go back to the lender very fast when things have changed. Report what has changed and report the new cash flow position, however low it is, so that a central position can be arrived at. The SACCO will not sit there and say do nothing. They have to show SASRA that they are working on a plan, and that plan comes from you. So there's a dual way where the SACCO is required to collect hard and to collect fast. For that to make sense to both of you, you also need to revert to the SACCO with a plan that reflects your true current situation and approximately how long this is expected to last, so that a reschedule of a loan, which can only be done once, the SASRA provision for rescheduling a loan is only reschedule that loan only once. A reschedule that is done with viable information and meaningful, so that we don't reschedule a loan for 6 months and at the beginning of the 7th month you are still unable to pay. We'd rather reschedule the loan for 1 year to give you enough time to turn around your scenario, knowing that SASRA can only allow a one-time rescheduling. That is what happens in the space. So for both parties, there are responsibilities and there are expectations, but the onus lies with the borrower. So you can imagine if point number one, if the SACCO knew your strengths, for example, in terms of other incomes, supposing you have some property income, might not be a lot, but it is there. It is consistent. It is not used to assess your repayment at the beginning of the loan. But when you come to number 5, things have gone wrong, and the SACCO is performing their role of collecting hard and fast. At that point, that knowledge of that income that is consistent is very useful. You may only provide a small portion of your rent to repay the loan consistently, so that the loan doesn't get into arrears. It's rescheduled, the amount being repaid is much smaller, but for a fixed period. It can't be rescheduled forever. It's say 1 year or X number of months while you are turning around. The SACCO will have their PAR not rising, and you will have your loan being repaid at a low amount and giving you time to turn around things. A very win-win scenario. But whereas one party is playing against the other, both people lose. Then the next point is what we are required to do here. Let me lift, I don't know if you can see it, sorry, it's not supposed to go like that. Credit appraisal. A credit appraisal is a requirement, the principle of lending as a very key principle of lending. Every loan must be subjected to an appraisal of ability to pay over the loan period. So that requires us to look at a few things, which I'm going to say here without necessarily showing them on the screen. The first thing is what we call the safety principles. If you're writing, write that. Safety principle. The safety principle, which is the first appraisal element, we look at what we call the 5 C's of credit. And the first C is character. Whether it's a business, there are elements of what we call character assessment. If it's a person, individual income, there are elements we look at in terms of character. But I'll give you a few examples. Doctors have gone to school, and one of the ways you funded your school was Higher Education Loans Board. If you turn out that you've been practicing and you don't pay your help, then you are deemed to be of poor character. That simple thing, 3,000 bob per month, can sweep your ability to borrow completely. So that appearing in CRB report is enough to deny you a loan, unless someone tries to be lenient. So once you fail to pay a small loan, you don't qualify for a big loan because that lack of desire to pay is uniform. Those who can't pay less should not be trusted with more. So a lot of character issues have to do with past debt history. It could be debt within the circle. It could be debt within any other financial institution that you are not servicing and therefore runs on your CRB. Having an unperforming loan in KMA itself reads on your CRB negatively. So to the extent possible, try to come back to the circle as early as possible with a working plan of a much reduced payment when things are really bad, such that the loan is put back, rescheduled and put back online before it reaches 91 days from the first failure to repay. You should not go more than 3 months with that debt not being serviced. It will look very bad on your credit risk. So that is a key thing to remember, that if the moment you are looking poor in terms of debt repayment, even the apps will not give you a loan. The moment you're showing that you have a debt that's not being serviced, it becomes a problem. And I have personally had a life with that. When I left employment, I entered into an agreement with my bankers that I will begin to repay the loan after 6 months. And I was repaying the loan, but their system was not recording it. And I didn't care to go and check that their system was not working the way it was. By the time I was getting to know, I was in bad books, yet I'm paying the loan 4,000 bob in excess every month. I wasn't just paying it at once. I was paying it in three small amounts, all of which coming from different sources. So that responsibility of checking if your credit is good is something important on you, not on the circle. It is you to ensure that your character is looking clean, both at the time when you're applying and later during the life of the loan. Number 2, capacity. Capacity is cash flow, and cash flow is assessed from 2 points of view. For a business, we look at, do you have a market for your services? Is the market sustainable over the long period? Now, it is this market that changes during recession, because the demand for services go down naturally. So for example, if you are running a hospital that was rallying on NHIF and was able to make good cash flows, and NHIF has now hit the wall, definitely, if that was the main reason why you are able to receive a lot of income, your income has really gone down. So the capacity to pay need to be assessed, and the dependencies also need to be assessed. For medical, that NHIF item is key, especially if you are running a clinic that is dependent. That is very key. It's a very key reason for people coming to the clinic, because it lowers affordability. So if your value proposition as a medical institution is for the market, what you call the public, people with much similar lower income, then you are at a higher risk than a clinic where people will go with or without NHIF. A premium clinic may still continue to receive a lot of income even when the times are bad. Slightly lower, but better than a clinic that was serving the masses that depended on a dependency like NHIF. So the idea is to ask, how quickly can you shift your value proposition to the market so that you continue to receive income from the premium payers, even though things have changed significantly. If that can't happen, you will be on a low income for quite a while. So that's an entrepreneurship side affecting your cash flow side. And it happens quite a bit. So those two C's, if the character has failed, we will not give you money. If you have passed the character, we go ahead and look for you. Do you have the capacity now? But the capacity is what now is subject to recession. It is what gets affected by the recession. It was good when we assessed you. When things have changed, we need to assess what is your current capacity. So come to the circle with a lot of information on your present income. If you don't do it, you are asking to be put on a black book. And the moment you remain in a scenario where your loan is not being renegotiated, you are officially in a black book. You are putting yourself in a place where it is your assets which you offered as security that will be used to repay the loan. You are denying yourself a remedy by not illuminating your income. I hope I am clear to the borrower on this one. The role of the borrower to provide information on the changed capacity is crucial, both at the beginning and subsequently, in trusting them for a loan reschedule. That role is squarely on your head. The circle will be under pressure as a CEO and the credit manager to get the loan off the book. So they will be looking at, if you are past 91 days, what do we do with the security? More than listening, chasing you to try and bring money. It is up to you to chase the circle, to show cause why they should listen to you, listen to your current situation. These are the numbers. Show them the numbers, actual, factual numbers. And they will look at those numbers and see for how long can we accommodate this loan on a lower repayment, say 1 year, say 2 years, while our client turns around. The third C are all conditions. What kind of conditions, including economic conditions, should be sustained the life of the loan for you to be able to keep repaying the loan? If the economic conditions change, the income levels will drop. If there are any subsisting situations, like in this case, the government policy as a condition around NHIF has changed. If it shifts rather, the income for the doctor or for the clinic shifts. So what conditions? So in a loan scenario, there's an assessment based on what conditions need to be sustained during, at this point and during the life of the loan for there to be enough income to repay this loan. I can assure you, whoever assessed your loans knew that there was a dependency called NHIF. And they can clearly see that that has changed. So you may have been seeing a lot of leniency for those who are on NHIF situation, because as much as a bad situation, it is one that will solve itself when the government eventually pays. The only issue is that we don't know when the government will pay. But I saw a fellow doctor of yours joining that crucial section as a senior on the desks of authority. I think you should use that office to solve the problem better, the place of networking. So under that condition, the safety principle, item number 3 called conditions. The conditions have changed. The job conditions have changed. You are supposed to have your employment to be able to pay the loan. Trump has said there's no more money to give to USAID, and USAID funded the project that was giving you employment. So the employment condition has changed. You now need to come to the circle and tell the circle, look, my primary income was salary. It is not there anymore. I have this locum, but I'll use that to survive. I have this short one that I'll use to pay my children's school fees. I only have this rental income of say 10,000 that I can give you in the meantime while I am reorganizing myself. Make that offer to the circle as early as possible when it is still in a position of remedy. You come too late, you might not be helped. The other one is what we call collateral. Every loan needs a collateral. So you always provide a guarantee as the primary security in a SACCO. KMA has provided for other security. So you can use your title, you can use your other title deed, you can use your logbook and those other assets, including asset finance, where the asset finance itself becomes a partial or full security. So because if you don't meet the first three C's, collateral becomes a fallback. I wouldn't want to imagine a scenario where we are coming to a clinic to collect the equipment, and that is what you use to generate the income. So it's better for you to go to the SACCO and explain your situation in writing, doing things verbal. Matters lending, when you are applying for a loan, you fill the form. Write, commit your position in writing, show the information in writing, attach evidence of where things are. Someone will listen to you better than when we don't do much. So those C's, the character coming first, capacity coming second, collateral coming third, conditions coming fourth. Conditions can be divided into two. The conditions internal and the terms, and what we call the terms and service, the terms and conditions. So it can be divided into to make it 5 C's or 4 C's. So those are the things we look at when we are doing lending. And the form you fill tends to pick up a lot of that information. May not pick it entirely the way it should be, but it picks not less than 90% of it. And like I said, there's always room for improvement. Things like what has happened now can now inform what else should we be looking for. I would suggest to you that part of what you look for, if you've not been, for example, looking for additional information, I have worked with so many doctors. A doctor may have 4 different incomes. It's just how you ask for it so that they are able to show you where it is and where they are. It gives you a lot of peace when things have changed. You can know how to work with him when you have a better picture. For you as a borrower, give the SACCO your full information. Then the SACCO will be able to be at peace to listen to you. And that is the only way we can help reduce the portfolio at risk figure by rescheduling loans based on a fact, not based on wish list. The rescheduling of loans must be based on fact. SASRA are very tight with that. So the credit manager will only be able to help you when you present your case as early as possible before we get into past 91 days. I hope I make myself clear. You can only be helped to survive with a lower income following the changed situation when you present your case with a lot of evidence as soon as possible. Do it before the loans begin to look ugly. So generally, the ones in blue are squarely on the borrower. The safety principles that I've discussed, the correctness of the purpose of the loan, that is one other very major source of poor loan servicing. A loan meant for buying an equipment ended up paying dowry. So the equipment was not bought and the income projected did not come. The lending process should be self-liquidating, to mean that whatever source of repayment you promised to bring should be able to come as and when it was expected. If it is a business, the sales should continue to be there in sufficient volumes to provide the liquidity. If you offered any security, it should be something that should be easy to realize. You realize today, if you're selling land in Kenya, it might take even a whole 1 year just selling land, especially depending on the location. Then especially the issues to deal with non-performing loans, there are always other complications behind there. The security and the viability of the project for which you borrow. Those are things that are squarely on the SACCO, on the borrower. On the SACCO is both of them. The portfolio itself should diversify to come from different sources. To the extent possible, should consider the place of profitability, suitability, green concerns, and social necessity. Those ones I will not discuss because that regards the entire portfolio of loans in KMA. But these 5: safety, purpose, liquidity, security, and viability, including that suitability, those items are squarely on the borrower, and the borrower ought to play their weight. When things have changed the way they have changed, please present your case in writing individually to be listened to early, so that if there is any rescheduling, it is done before things begin to become too heavy on your shoulder. What happens when you breach the principles I have explained? If you don't get the safety principles right when you are assessing the loan, you will be lending on a false premises, and that loan will be in trouble from almost the beginning. If the loan was for a purpose that sounded right, and unfortunately, the SACCO is the only place where you can take an emergency loan to do something that is not an emergency. So if you borrowed on an emergency to do something that required a long-term loan, not a short-term loan, you are missing your cash flow available. So getting it right by saying the right thing for the purpose of the loan will help the SACCO officer to point you towards a product that would be ideal for what you want to borrow. So that we don't give you a loan on emergency because you haven't borrowed an emergency, and the loan is short-term, yet the need is long-term. When things change, that exposes you very fast, because what looked like good cash flow suddenly go away. Now you can't pay that short-term loan. You are now requiring a long-term loan. You ought to have taken the long-term loan at the beginning. The liquidity elements, like I mentioned, a business, for example, depends on selling the services, the medicine, the equipment, all those things you sell to us when you come to your clinic. Those things you bill us. That's the process of turning those things back to cash. So when the uptake is low, the liquidity becomes an issue. Go to the SACCO and explain that this is what I am going through in my business. When I borrowed, I was doing 80,000 per day. Now I'm doing 8,000. I'm doing 10 at the end of the day. I'm doing 20. I'm doing 30. Go and show the sales numbers for 3 months. You should be believed when you go there with the general ledger. They will look at it very quickly. Even if you didn't give that information at the beginning, now it will make sense. This is the numbers when I came. These are the numbers now. The lady in charge of credit will be able to have the capacity to assess both based on fact, not based on a nice story, based on fact. Collateral, security, the viability of the project. If the viability has changed because I bought an equipment that was supposed to be the only equipment in Upper Hill, now there are 10 in Upper Hill. The clinics around Upper Hill and other barrels are no longer making sense from this equipment. Go back there. Please put your case and be listened to. Don't wait until when things go bad. Because if you don't, the SACCO is only seeing one picture. Our client who has refused to pay the loan. The word refusal might not be the word in your mind, but that is what the credit is saying. They are looking at you as a cheeky member, promising and not delivering. So, like I said, this is now where the borrowing needs, whether business or personal, meet with the cash flow. The SACCO's role is to facilitate the creation of credit and the restructure of the credit to reflect your changed situation based on fact. I want to repeat, the SACCO's role is to generate a loan based on fact, and when those facts change the structure of the loan based on fact. Without the facts, her hands are tied, because there's a lending process that she has to follow, has to meet the minimum requirements of the regulator. So, like I said, when personal finance needs are needs that are personal in nature, you can call them lifestyle-based expenses. but the business finance needs are business in nature. They are either money for working capital, money for equipment for your case, money for doing the physical infrastructure of the clinic, monies that uplift or make possible the business to be there or to expand. Now, the personal income in nature and the personal needs, the personal income like a salary and the personal needs are tied at one point. They are connected. You should first try to use your personal income to cover your personal needs. And when you have a business income, the profit is what is considered possible personal income. The cash flow is not personal income. So if the business is not profitable, then that means that you will be depending on the personal nature of income to cover your personal needs. Any breaches between the two lower the cash available for repaying the loan. So typically, not more than 50% of your salary should be taken towards loan repayment. But no ASACO takes up to 67%. I want to repeat that in the space of personal finance, ideally only 50% of your income, your disposable income, should be used to cover your loan repayments, all the installments. But I'm also saying in the same breath that a ASACO model is to lend up to 67% of your personal income. Do you know the impact? The impact is that 17% extra should ideally be used to generate income. The 17% over and above 50% that is given to you to repay extra loan. You're the one you are denying your lifestyle to repay the loan. Ideally, it should be used to generate income, to generate additional income. And where it is not used to generate additional income, you are using it to uplift your lifestyle. And unless your income is really large, you will almost always be in a financial distressed situation. You'll be living from one loan to another. At one point, you'll be having Okoa Jahazi kind of loans. Just because you've consumed more than you ought to consume, you used a loan meant for good purpose, for consumer purposes, and you've taken more than half your income meant for your lifestyle by a further 17% towards loan repayment. So you are now living on 33% only. So if you don't have additional income from other sources, you will almost always be in a distressed financial position. Again, when you're looking at the business profit, you should only expose about 40% of the profit towards loan repayment. The moment more than 40% is going towards loan repayment, you are most likely hurting the business. You are most likely hurting the business in terms of the cash flow needs for working capital and cash flow needs for redoing the equipment or buying other equipment. So there's a subtle point there in which our balancing of our spending and our personal spending and business spending can affect our abilities. So again, that we can subject to Q&A questions. As of now, what I want to focus on, are there common mistakes that occur in a ASACO scenario, both from the borrower point of view, and the lender point of view? Yes. ASACO will lend to your needs. If you want a short-term capital, you present the case for a short-term capital, they'll give you money for short-term capital. But if you now apply the money given for short-term, meaning monies that are repayable in a year, to now buy an equipment that is long-term in nature, we call that a mismatch in financing need and borrowing purpose. So when the financing need or the borrowing need and the borrowing purpose are mismatched, the borrower is the one who will suffer the consequences, because you are borrowing on a short term which is taking more of your money, the cash flow per month, yet you needed to borrow on a long term that would have been taking less. So the moment you are hit by a pothole, like now, Trump era or the NHIF removes your income substantially, you begin to feel the hit. So that mismatch might not be a big issue to the lender who is lending. But to you, it will come to the fore the moment your circumstances change. When the circumstances don't change, you will not even feel because your cash flow was adequate. You have more money, it can cover that lending mistake. But when the income that was supporting that goes, you begin to feel the hit. Repairs and maintenance expenses for medical equipment could be quite a bit, especially when they begin to get old. Those are expenses that need to be illuminated clearly, so that when you are being lent to on those things, somebody can see them clearly. So a funding by appropriate product rather than a mismatch, going by the matching principle of credit, you can avoid problem by being very honest about what you want to do. So that then the lender tells you this one, the most ideal product to borrow on is this one and not this one. But if it happens, as most of us sometimes do in the SACCO environment, you are not very honest. When things change and your cash flow begins to decline, you might begin to feel the hit, even though you are able to cover that well when you are borrowing. I hope up to now I have made a lot of sense, because if I have not, I don't know whether I have any more minutes to do so.
Now
So
we have
like
about, I think about 7 minutes to the end, so maybe you can tie up.
I've actually finished everything. I've talked
Then
about
we can go to Q&A.
all the circles, yes. I mean, all the
Yes.
issues. I think we're going to go to Q&A right away, so that then we can be able to respond to individual situations.
Yes, there are a few questions. Sorry, let me go there on the chat. For your Q&A, there are not many though. There's a member who's asking whether it's legal to be in one or more than one SACCO. Well, I think people are in more than two SACCOs, but I think what is prohibited is being in the board of more than one SACCO. Like as a board member, myself, a board member of KMA SACCO, I cannot be in another board of another SACCO. Maybe Mr. Mayor, you can comment on that, whether it's legit.
I think the first legal position is that you should not be in two SACCOs with the same objective. If we strictly go by the law, the Cooperative Societies Act, as it was, says you should not be in more than two SACCOs with the same objective. What do I mean? KMA and Kimisitu have the same objective. KMA and Steamer have the same objective. But KMA Housing and KMA SACCO have different objectives. So you could be in KMA SACCO and Steamer Housing, not necessarily KMA Housing. That is still legal. But the moment you are now in two SACCOs with the same objective, already you're operating in the illegal area. You are, like you say, you aren't even allowed to be in leadership position in more than one SACCO.
Yeah.
So unless you are just using one SACCO just to save, you already on the what they call in law ultra vires.
Yeah, so that is sorted. Then now we have Muslim colleagues who are here. So there's one who's asking whether Islamic banks offer services or loans. Yes, we do have them. There is the Sharia compliance. I think that can be taken quickly. Those who are Muslims have that Sharia compliance. We don't have it yet in our SACCO, although there are SACCOs like TIMA that already have it. But I think it's a work in progress. We have been trying to consult over the years to try and see whether our Islamic scholars can help us craft a product, but it's work in progress. Now, Joshua Nyagol asked, debt collectors, I think he's talking about debt collectors and financial management, and he says he's been cautious on KMA loans. I debt collectors apply to all SACCOs, so it's not just KMA SACCO. It's one way in which we collect our, we go for members who were not able to pay us, in addition to getting money from guarantors and also auction, and also using the legal route through the cooperative tribunal. Now I'll move to this. Yeah.
Yes, debt collectors or honest would be different. Yeah. If people are honest, they are part of the information coming to the circle when things are wrong rather than waiting to be chased. There would be no need for a debt collector. Debt collectors only come into the space when there's a dark side of a two-sided transaction. When the circle does not know what you are doing or what you plan to do about a loan that you borrowed, which you are not paying, they are obligated and required by SASRA to collect the money by every means possible. So the way to avoid this is to have a scenario where there's a clear dialogue, right? Like right now, people have lost jobs. Let them come forward and present their situation. So the circle will have a clear picture on what you're doing. But if you disappear for 6 months, 7 months, you can't be reached on phone, then there has to be a debt collector to find you.
Yes, we do that very often. Now, Felix Ombati asks, I think you should help members to be equipped with financial literacy, but financial literacy. It pains me seeing doctors working in their old age, still looking for extra shilling because we are told to read hard. But even investing in the health sector is done with, remains by non-medics. So I think that is exactly why we're here by Dr. Felix. That's why we are talking to our members, and that's why we have a circle that is now about 7B. We are equipping our members, they get loans to develop themselves and to do projects that can give them passive income, as has been emphasized here. Passive income is what will help doctors to escape working at old age. So Mr. Patrick Wameo, I think those are the questions that I seen on the Q&A chat. I don't know whether there's any other questions that have not been answered, but it's 2 minutes to 8:30. Yes?
Allow me to make a comment on Ombati's point.
Yes.
Mr. Ombati, I have a benefit of having been born around some of the very old doctors that this country had, the ones who were in their 60s. In the hood I come from, they were very financially stable. But what happens, mainly among doctors and engineers, you stay in school quite a while. So you miss a phase of life. By the time you come back, you don't begin to invest very early. I have seen doctors who began investing early. Their lives changed quite a bit. So doctors have the cash flow, but they need to begin to invest in alternative income early enough, just when you have that time when the money is still sweet and a lot of it is coming. Because then that reduces the need for you to work long and late.
Thank you, Mr. Patrick Wameo. I think this has been a very illuminating talk, and I believe our members are now very well empowered. They now are aware that we will be requiring more information. Please do offer more information to us, including M-Pesa statements. Give us your bank statement. Show us your clinic statement, so that at least when we are assessing you, or when you go into trouble, like now what has happened during these changes we have, we will always be lenient to you and will listen to you. So don't start bringing in your other sources of income when you have already defaulted. I think that is one of the most important points that our members should take on this. The other thing to know is that we should be informing us early enough. We've had members who are able to foresee trouble. They write to us 1 month before so that we're able to make arrangements. But if you wait for 2 months and then switch off your phone and come after 4 months and your loan has already gone into default, then it becomes very difficult to help you. The other thing is that we are always ready to do what is called restructuring for those who are in extreme circumstances and are not able to pay. So you can always call Esther, Elizabeth, our credit team. They'll always work out a way of helping you. But on restructuring, we emphasize that you finish all arrears. So it means that always come before the default comes. Otherwise, if you come on your defaulted 1 or 2 months, we'll ask you to clear the arrears so that we can now consider restructuring. You don't restructure your loan plus the arrears. I think that point should be very clear so but we don't have problems. Yes, we've managed to reduce our NPL from a high of 9 to about 6.6, as you see in our accounts. And that has really helped us to try to reduce the provision expense. Then the NPL comes as an expense. So that should translate to more returns for our members. I don't know whether there's any other question, members. You can go through the...
there was one there.
I'm not seeing it.
Up. There was one by a gentleman asking about a guarantee. He's been asked to pay a guarantee almost a year later. The question has gone from the screen.
Maybe it has been answered by our officers, Esther and Elizabeth. Yeah, but I think our members don't have much to ask today. I think they have gathered all the points you have said, especially the 5 C's. So they now know what to look at. Sometimes we decline to lend, and those are the factors that you have raised there. If you realize that you don't have enough, we ask you to maybe borrow within your deposit or to borrow within your payslip. So this is some of the questions that we look at when we are appraising. Yes, so I think that is it. Thank you, Mr. Patrick Wameo, and thank you everyone who has attended this webinar. It's recorded, so we'll send the members into their mails to be able to listen at your free time. Thank you. So please do fill the survey monkey at the end of the talk.
Thank you.
It's 28 minutes to 9. Our webinar is over. It was set to end at 8:30, and that's exactly 8:32. Thank you, Mr. Mayor. We should be calling you. We should be calling you to talk to us further in the days to come, especially at the board level, because you are going to get new board members. In the next week, we'll have an AGM. We'll get new board members, and our committees will change. I might not stay in credit, so we might get new members joining the credit department. So if need be, we'll call you to illuminate more on this topic of credit appraisal and how to sort of deal with the default, and also how to do proper appraisal. So that we should be able to schedule an appointment within the course of the year. Thank you so much.
Thank you.
Bye.
The slides are already with you.
Oh, sorry, I think I forgot to ask the chairman to, I forgot. There's something I forgot. Bwana chairman, umetoka?